Equity markets seem to be reacting quite unusually at the moment, in that good news, good economic news sometimes is received as bad news for markets and vice versa. Bad economic news can be received as good news. So it's all quite confusing, but we're going to make sense of it today. I'm joined by Dean Cook. Dean is a new face to the portfolio management team in Aviva Investors, a new portfolio manager on the multi asset side. We're delighted to have Dean on board. You're very welcome, Dean. Welcome to Aviva Investors. We're going to talk about this topic today. And Dean, I want to start off by asking about unemployment data in the US. And in particular, this point about it seems like good, strong numbers can sometimes equal markets not being so happy. So, can you just explain what's going on?
Sure. Thanks for the warm welcome, Shane, and the interesting topic today. In simple terms, stronger employment numbers, and we're going to use the US as an example here, means that inflation is probably going to stick around for a while longer, which isn't great for markets. The most looked at data point is the non-farm payrolls, comes out of the US. Last month, we saw January's data, which was incredibly strong. We saw over 500,000 jobs added to the US economy against an expectation of only 200,000. And that caused stock markets to fall. These numbers might be revised, but at first glance, it was indeed good news, which markets took as bad news. The numbers for February come out later today, so at the time of recording, we're not sure if the strength is going to continue. We're expecting about 200,000 jobs to be added to the US economy. There's a range of possible outcomes here. Another stellar report like January, markets probably won't like that. On the flip side, you could have a dreadful report, such as job losses, and markets wouldn't likely like that either. What we're looking for here is a number somewhere in the middle, sufficient that investors can be confident that jobs are being added to the US economy, but not so many that it looks like the US economy might be overheating.
Okay, not too hot, not too cold, something in between. Okay, so on this point of good news and bad news, on economic growth, I'm interested in some of these other economic factors, not just the unemployment rates. We look at all sorts of stuff. And again, it seems to me to be a bit of a head scratcher that some of these economic indicators could be signaling strength, and yet markets aren't so positive. Can you just talk a little bit about that general growth and what it means for markets?
Sure. Yeah. As you say, we look at all sorts of factors and data to get a sense of how economies are performing. And as you say, sometimes strong data doesn't necessarily mean good news for markets, and the converse as well. The UK is quite a good example here, and we'll use that as a bit of an example. We've seen weaker economic growth figures in the UK compared to other developed markets. Weaker economic growth might mean that central banks are a bit more limited in how much they can hike interest rates. Because if you're in a recession and people are struggling, you don't necessarily want to hit them with higher mortgage repayments. So potentially it puts a bit of a handbrake or a ceiling on how high interest rates can ultimately go.
And what to feed through from that into stock markets?
That's the important thing, isn't it? Well, generally speaking, equity markets like lower interest rates. So if weaker economic growth does lead to lower interest rates, it can help to push equity markets up, assuming earnings hold up, which so far they have. However, I guess coming in the opposite direction is an awareness that weaker economic growth may ultimately hit company profits, which wouldn't be so positive for markets. So it's not so clear cut and something we keep a with eye on.
Okay, yeah. So if you see a severe downturn, it's obviously going to ultimately impact on company earnings, which will ultimately impact on share pricing. Okay, really clear. I mean, my attempt at summarizing this is that markets seem fixated on interest rates, fixated on inflation. And if you see signs of those coming down, inflation coming down, and interest rates coming down, markets are happy. Anything that flies in the face of that, they're not so happy, at least not in the short term. That's my simple summary. Dean, that was brilliant, amazingly clear. What a debut! I mean, one other thing just to mention before we finish up. It is a little bit random. I'm going a little bit off piece here, but we were chatting in advance of this catch up, and I was talking to you about the guitars that are hanging up in the background, and we got talking about music. And it turns out we've got quite a similar taste in music, and we like some maybe lesser known bands, one of which is a band called Modest Mouse from the States. Some may have heard of them. And it's a bit of a happy coincidence, but I guess my favorite album by Modest Mouse and your favorite album is an album called Good News for People Who Like Bad News. So it's quite a happy coincidence that the topic we're covering today is pretty much aligned with that album title. Anyway, we will be back next week. We will put another fund manager on the spot. We will ask the difficult questions. We look to do it all in about 5 minutes. Until then, take care.